Hey guys, thanks for joining me today. This is actually going to be the first of several training videos on how options work. I get a lot of questions on what are options, what are calls, what are puts, when you sell them, when you buy them, what are all the differences? And so I thought I'd put together several videos that would illustrate what each one of these are. So today we're going to be talking about a call option, specifically a long call option. Let's say you're interested in buying a stock that you are 100% confident the stock is going to go up. Rather than shelling out several $1,000s to hold that stock or several $100s, whatever it takes to hold 100 shares, well, I can hold 100 shares for much less with the call option. And I can do that maybe, say, for $500. I could hold 10,000 shares worth of stock for $500. I'm hoping that that price goes up. If the price goes up, I'm going to have to pay for the cost of the call option. And then I need to overcome a certain price point, which I'll get in a second. And then when it goes all the way up for as high as that thing goes, and potentially I could have unlimited profit for holding something for $500. Sounds like a pretty good deal, right? The other benefit is if I'm wrong and the stock goes down, rather than losing my shirt because the stock fell in half, all I'm going to lose is what I paid for the option. I'll show that in a couple of diagrams here in a minute. But an option gives you the right to buy the stock but not the obligation. So I hold an option that says I can buy it for a certain price in the future. Options provide a great deal of leverage. I could hold several $1,000s worth of stock for maybe a couple $100. It has limited risk. It's only the amount that I pay for that option is what I could lose. But I have unlimited profit potential. If this thing goes to the moon, great. But I have to have a strong bullish conviction. I not only have to be right in the direction, I have to be 110% right, meaning I have to be right enough to overcome what I paid for the option. But also, options are time sensitive. So they have a time component, they do expire. So you need to be right in a certain amount of time as well. So you can't just hold this thing forever. So think of it like this. Let's say you want to buy a house from a year from now, and you have an idea that the house market is going to increase. I can go up to the owner of the house and say, I want to buy this house. It's a $250,000 house, and I'm going to put an option on it. I will buy your house for $250,000, and I'm going to give you $5,000 today to buy that $250,000 house a year from now. Regardless if the price goes up or not, the homeowner is guaranteeing me that I can buy that house for $250,000. So it's great. We execute the contract. A year from now, that house goes up in value to $350,000. Well, guess what? That owner of that house still has to sell it to me at the price that we agreed on back then. So that means I made almost $100,000 profit, right? Because I get to buy it for $250,000. I get to sell it for $350,000 because that's the value of that neighborhood. And I got to do that with a $5,000 investment all a while ago. So now I can buy this house for $250,000, turn around and instantly sell it for $350,000. That's what an option does on stock as well. Let's do the inverse. Let's say the house tanks in value. Something happened, crime shot up, subdivision, it's just terrible now, and the house is only worth $100,000. Guess what? I can walk away a year from now. All I'm out is the $5,000. Even if that house is worth only $100,000, I'm not losing $150,000. I'm only losing what I paid for the option. Stock is exactly the same way. This is what the option diagram looks like. So I'm going to pay for that cost. That option is this red here. This is what I'm paying, that $5,000, for example. I'm going to flip it. Let's go to stocks. Let's say I have a $100 stock. And I'm agreeing that at some point in the future, I'm going to buy this stock for $100. And the guy who owns the stock says, yeah, I'll sell it to you for $100, but it's going to cost you. It's going to cost you $5 per share, which is like $500. So an option is always worth 100 shares. It's always worth 100 shares. I should say always, 99% of the time. It equals 100 shares. So I'll use terms interchangeably, like if I say $5, that might be 500 because then I'm going to put a multiplier of 100 on it, right? I'm going to give that guy an option to buy it for $5 or 500. So this part here, a year from now, the stock has to move to $105 in order to break even, right? Because I bought this $100 contract for $5 or 500 if I multiply it by 100. So I'm holding 100 shares. It's at $100. That would cost me $10,000 to hold it, or I can buy an option for 500 and hold the same $10,000 worth of value, right? Or 100 shares. Okay, so in the future, I have to overcome this. I have to go to 105 in order for me to be profitable. But if I go up to 120, I'm going to make 15 bucks or 1500 because I got 120. My break even was 105. That's simply 15 multiplied by 100 is $1,500 because I'm holding 100 shares. So that's how this works. It's pretty darn simple. Cost of the contract is 500. I got to overcome that. So that means I bought it, and when it was $100, it needs to go to 105 in order to meet my break even. Beyond 105, that's all mine to keep. So if it goes to 120, there you go. That's how a call option works. Pretty darn simple. If it goes all the way down to $90 or $50, all I'm going to lose is what I paid for this, which is 500 bucks. All right, so that's the beauty of a call option. It allows me to have a great deal of leverage for a little bit of nothing. Let's bring it home a little bit. Let's talk about EA. EA, Electronic Arts. So they are releasing a game. Looks like August timeframe. They released the beta, and the stock looks like it's doing pretty well. Here we are, September 1st. Which way is it going to go? 3 things I want you to think about today. Options can get very complicated very quickly, but I only want you to remember 3 things today. One of those is a strike price. So a strike is like this. Let's walk through this. So let's say this is going to be good for 30 days. I'm going to go 30 days out to say October. I have a contract here at 170. I'm going to have one probably here at 172.50, 175, 180, 185. I'm just going to keep going up. Each one of these is your strikes. Then they go all the way down. If I were to look at an option chain, they would go all the way down. They would go all the way up to some number way up that might be impossible to hit. So which one do I buy? Depends how strong your bullish thesis is. So I think the stock is going to go up because they're releasing this game, I think sometime in September, maybe October. And I think it's going to be a hit. It's just an example. If it's going to be a hit, I might say, well, let's buy this guy right here. I'm going to buy this contract, $180 contract. And that might cost me $4 or $400. The higher up I go, the cheaper it's going to get. This might only be 200, and this might only be 100, and this one might only be 50. The problem is I've got to get all the way up here. The stock has to go all the way up here in order for me to be profitable in those 30 days. The only reason why it's 50 bucks way up here is because the stock has to go up there, and what are the odds of it getting up there? So I'm going to hold 100 shares for $50 means that there's probably a good chance it's not ever going to get up there, because why would somebody sell it to me for 50 bucks? Whereas this guy down here is going to be like, yeah, you're already in the money, man. You're going to pay a whole lot more. So these are always going to be more expensive the deeper you go. At the money, let's just say it's $171.95 today. I'm going to buy a $175 call. Well, it's selling for 500 bucks. I'll show that here in a second. I've got to get to 180 just to break even, based on our example a minute ago, right? So now if I go to 185, I'm going to make 500 bucks because I've got to 180 plus another $500, and I made, with my $500 investment, I made 500 because I had to get to the 180 and then just beyond. All right, there's another number here. So that's the prices, and they go more expensive deeper you go. There's another number here called delta, and it's the odds of it getting to this. So this might only be 20, this might be 30, this might be 50, and this might be 90, okay? Delta is 2 things. One, it's the probability that the stock is going to expire at that price. The other thing it represents is the amount of shares. So it is equivalent to holding 90 shares if you bought this one. If you bought this one, that means it's equivalent to holding 50 at that moment in time that you bought it. So if I were to buy it exactly today, and I bought this one for $500, this one for 500 bucks, guess what? It's going to be the equivalent of me holding 50 shares. So if the price goes up to 172 tomorrow, let's say it's 171.95, and it goes up to 172.95, that means I'm going to make 50 bucks because my delta was 50. It means it's the equivalent of holding 50 shares. This is the equivalent of holding 90. This is the equivalent of holding 30. Now, there is time decay, so that will work. It's just that moment in time. But that's for a more advanced topic for today. Just think of it like this. You're holding 100 shares for this price. Whatever strike, whatever contract you go into, okay, that's what that represents. The probability of it hitting that point is delta, and it also is the equivalent stock position. Let me show you what an option chain looks like. The second thing I want you to remember is expiration. So each option has a contract date with it. So when I click on this, if I say, hey, I think by September 19th, it'll be a certain price, or by October 17th, it'll be a certain price. These are weeklies. These are monthlies. So I can execute contracts, in weekly increments or monthly increments. The further out I go, the more expensive they are. So let's say I think I'm going to hold that stock, and I think that by EA is going to release this game, and I think it's going to go out like gangbusters. So here we are. These are the prices, and these are your strikes. So $175 call is selling for 500 bucks or $5 per share. So I can hold 100 shares for 500 bucks, or I can hold 100 shares for 310, but it's a $180 contract. $185 contract cost me $1.80 or 180 bucks. The problem is, let's just go with this 190. I can hold a $190 contract option for 105 bucks. Here's what has to happen. The stock has to go to 190 just to be at my strike price. Now it's got to go to 191.05 just to make my break even. And it's got to do that by October 17th. So that's why it gets cheaper and cheaper to hold this, because what are the odds that it can go up that high? That's a $15, $20 move. Okay. The other way I can look at this delta over here, this column right here. See this delta? All right. Over here, there's a 14, it's 0.14, which means it's a 14% chance of it hitting 190. So that means it's a 14% chance I hit 190. Then I got to go up a little bit more, like another $1.05. So I'm going to hit 191.05. And then that's where I start making money. If I go to 200, well, guess what? I'm going to make that $10 minus $1.05, which would be $8.95 per share. I'm going to make 895 bucks for $1.05 or $105. That's a pretty sweet deal if it hits 200. If it falls and we never make it up here, well, I'm going to lose the $105. That is a downside risk. But the good thing is I'm only going to lose the 105 bucks. So it's a positive and a negative, meaning that if the stock fell to 160, lose 105, it makes it at 185, I'm going to lose 105. I've got to get all the way up there. The positive is I only lost 100 bucks, but the negative is I could lose 100% of my investment. So that's kind of a cool thing about call options. It lets me hold a lot of shares for a little bit of nothing. The deeper in the money, this is deeper in the money. Remember I was telling you about deeper in the money? The deeper I go, the odds of it being at this price is much greater. That's why this guy's willing to sell it to me for $25.10, which is 2,500 bucks. So I can hold $17,000 worth of shares for 2,500 bucks, and there's an 88% chance that it will be above 150. So I can use leverage to my advantage and do very, very well. So that is it in a nutshell. The things I want you to remember today: call options are bullish. You have a bullish thesis. You hold stock for a much lower price called leverage. And you can hold these option contracts for months, sometimes years out into the future, or maybe even just days or weeks. It's depending on what your conviction is. That if you're only holding it for a week or two, it's going to be a lot cheaper. But they do have a time component. They do expire. So I hope you like this. Let me know. I'm going to do more of these. They will be in sequence. They're going to get more and more difficult. The next one we're going to do is a bull call spread. It's where I can hold the same shares, but I'm going to reduce my price a little bit. So stick around. I'll be posting that one here in the next few days. Send me some comments. Let me know if you like this, subscribe, and I hope you have a good one. Thanks. Happy trading.